So as a company owner, a lot of people are trying to beat the tax man. Can you give me any tips?
As a business owner myself, I think it's really important to focus on trying to pay the least amount of tax possible. And there are various ways in which business owners can do that. Firstly, by paying yourself as little as possible, which I know sounds maybe easier than done, but thinking about whether or not you can employ a partner or indeed children legitimately to reduce the amount of tax that you all pay as a collective. Use of expenses, there are certain things that revenue will allow you to pay for legitimately, such as the use of your mobile phone and certain expenses as well. But also making provisions towards things like pension schemes where business owners can afford to put a lot more of the earnings from the business into a pension and avoid the tax man completely. Finally, there is one relief that's available for business owners, which not many of them know about, where you can leave money grow and build in your business and make sure the money works for you, where at the age of 55, you can draw that out tax-free up to the tune of 750,000 euros. And if there's two of you working in the business, that will enable you to take as much as 1.5 million from the company.
How do you save for your children's future needs tax efficiently?
We have a really penal tax system in Ireland, which only allows you to gift up to 6,000 as a couple to any one individual, including your children. And that can be quite problematic if you are looking to try and give your children a head up, a step up for things like getting married, buying a car for them when they just are in a position where you want them to become more independent, or indeed paying for their first property. The way to work around this is that you can set up a savings plan, put as little as 100 euros a month up to the maximum 500 a month, which is the 6,000 euros, and get the money working and building up for them for when they need it in the future, and it doesn't incur the wrath of the tax man.
Buying a property in your pension, how can you do this and why would you?
There are two main advantages to why anyone should consider buying a property in their pension fund. One is that it's an income generating asset. And as we all know, rents, which can give you a good return of investment, which can go on indefinitely beyond when you retire. The second reason why a lot of people consider this is because you can essentially avoid paying tax on the rental income. All of it is paid into your pension scheme, but also any growth of the property, you do not have to suffer capital gains tax on. However, there's a couple of things I would warn you about. Firstly, that there is sometimes a lot of advisors who charge excessively for enabling you to do this. And you have to recognize that putting a large asset into your pension fund doesn't necessarily give you enough diversification. So the key message I'd like to give is make sure that you get independent advice. Don't pay too much for any financial product that you buy, and make sure that it's formed part of an overall financial plan for yourself.
For anyone facing increased mortgage payments, what is the best advice you can give?
We've seen a huge rise in mortgage interest costs over the last 2 years. And there are certainly ways in which I think people can mitigate against that. A lot of people who are on fixed rate mortgages, for example, don't realize that there's often absolute ability to pay down the mortgage early or refix your mortgage without any penalties or charges. The simplest advice I can give you is engage with your bank, find out what your options are. And in a lot of cases, if you are on a tracker or variable rate mortgage, consider whether there's an opportunity for you to pay down more of the mortgage now, which comes at zero financial penalty, and look to possibly fix that at a lower rate, taking advantage of things like a green rate mortgage if your property is of a reasonable BER rating.
And can you give us an update on where the government are at with auto-enrolment?
So auto-enrolment is the government scheme that forces employers to provide a pension scheme for their staff. It's due to take effect in 2024, and we believe it'll take effect on the 1st of September. There is going to be more information in the coming months as to when it will be announced. What I'm saying to business owners is you need to prepare for this. You need to understand about the fact that it isn't a great opportunity for them insofar as I don't like auto enrollment as a vehicle. My issue with it is that it doesn't allow any flexibility. It doesn't provide for any advice for the employee or for the employer. And also, there is no ability to draw the pension scheme earlier than the normal state pension age, which is 66. There is an opportunity for employers to look at setting up their own company pension or ensuring that all employees are joined into their pension scheme, even at a different level, that will allow them to not only save money, but to provide a much better relationship with their staff.
For anyone that's facing increased health insurance costs, what should they do?
So we've seen all of the three providers recently announce further increases to the cost of health insurance. Leia just announced another rise starting on the 1st of April of an average of 7% across all of their policies. The key thing I'd say to all people is three things. Firstly, make sure that you review your policy every year, and the time to do that is a month before the renewal date. You are mandated to receive your renewal. Make sure that you're on the right type of plan for yourself, and consider what level of inpatient care you need, which is going into hospital either overnight or for a day procedure, and outpatients, which are claiming for things like GP, physio, and so on. And whilst you may not necessarily know about the variety of different plans that are out there, the HIA have a really good website that allows you to use, but get impartial advice. And this is where we can help you. The other message is take advantage of online discounts. I'm a Leia customer and I always avail of an online discount of 10% on my own plan, and also kids offers where you pay for one child and get the others free. This will save you a huge amount of money. The third and final thing is consider whether or not you actually need health insurance, particularly if you're younger than 35. There is no levy if you come off health insurance and rejoin it. Not something I'm encouraging people to do, but if you are trying to juggle various different financial costs you have to pay for, particularly if you have children that have been on health insurance and have reached adult age and the cost for them starts to really spiral, you need to just work out what it is that you're spending your money on and making sure that it's appropriated in the right way.
Is it important for somebody to have a will?
It still amazes me, but over 70% of people in Ireland don't have a will made. And yet it's a really simple thing that we can get done, normally costing less than 100, 150 euros. The reason why I think a lot of us don't make a will is that we're not yet ready to think about the next stage, obviously, if in the event of something happening to us. But as part of, the suggestion around planning for the future, it is something that I would absolutely encourage you to do, because otherwise you could end up in a situation where the taxman is taking a lot of the assets that you've worked towards and it doesn't end up going to the people that you want it to. My advice is reach out to a solicitor, get a plan made. And firstly, I'd speak to a financial broker who is impartial, who can help you assess what assets you have, including things like your pensions, but also your liabilities, such as your mortgage and loans, and put them on a schedule where that will make the conversation with the solicitor a lot smoother. But it is absolutely something I would encourage clients to do, especially if there's been a change in circumstances, such as getting married, divorced, having a child, or buying a property.
How can somebody boost their savings by an immediate 66%?
When I talk to my clients and we compartmentalize into short, medium, long term, the focus for long-term savings traditionally focuses around pensions. And whilst some people may not necessarily understand pensions or may even have a pension, if you're earning over 42,000 a year, which, bearing in mind the average wage in Ireland is around 46,000, it allows you to save 40% of every payment that you make into a pension scheme. I.e., you put 100 euros into a pension, it costs you 60 euros. The 66% boost is the other way of looking at this, where if you put 60 euros into your pension, the government bring that up to 100 euros. And if you do a simple calculation on your calculator by putting in 60 times 1.66, that's 100. That's a 66% boost that pretty much is staring most of us in the face. And I think it's a really great vehicle for people to benefit for themselves in the future.
What can you assist somebody with who's facing redundancy?
Redundancy, unfortunately, is becoming more prevalent. And we've seen that with a lot of companies who have announced redundancies over the last number of months. Where we can help people is by helping them in the options that they receive. And normally they're not given a lot of time to make decisions such as the severance package, but also their pension fund. There's two strands to this. And what I would say to them is that it's really important to make the right choices, because by you ticking the wrong box, you could find yourself losing thousands upon thousands of euros that you should be entitled to. The key thing I would say again is get independent advice and make sure that you know what your options are. And even if it's just in terms of reinforcing what you feel makes sense to you, I think that's a really important thing for individuals.
The Employment Investment Incentive Scheme, would you recommend this to clients?
So the Employment Investment Incentive Scheme, or shortened as EIIS, is a scheme that's been available since 2011. It's been improved a lot over the last couple of years and basically gives high rate taxpayers an opportunity to reduce their tax by somewhere between 20 and 50% of the amount that they put into this scheme. The way the scheme operates is that it's essentially lending money to an Irish indigenous company. There's about 70 companies or so a year that look for this type of finance. They range from very small startups to quite established, profitable businesses. And it really is important to make sure that you get appropriate advice and you know what you're investing your money in, because as much as it's attractive to get a tax reduction and to be given money back by the taxman, you don't want to have a situation where you put money into a company to never see it again.
Old company pensions, what should I do?
We often come across individuals that have pension schemes from employments. We find that most of us work for at least 5 different companies throughout our working lives. And a lot of us don't really know what we have from the pensions that we previously worked in. The key thing is to get an assessment in terms of where you are with those pension schemes. Are they performing for you? A lot of people have this notion that they should consolidate their pensions, which I'm not normally a big fan of. And the reason for that is that having various pensions provides more flexibility. It allows you the option of drawing some of those pension schemes from the age of 50 onwards. But the key message I'd give to all individuals is make sure the pension's working. Is it appropriately invested? Are the fees low? Because if it's not appropriately invested and the fees are not low, then there are options in order to get it managed in a more favourable environment and get advice as to how to do that.
For anyone living in Ireland but having worked in the UK previously, are they entitled to the UK state pension?
So having worked in Ireland myself back in the 1990s, for anyone living in Ireland who worked in the UK for 3 consecutive years over the last 30, who hasn't reached the state pension age of 66, in my opinion, they have a massive opportunity to basically get money back from the UK government, guaranteed from the time that they reach 67 years of age. You can buy back state pension years, going back as far as 18 years, but you have a limited time frame to do that by. And the purpose of doing so is that you need to have 10 qualifying years. So if you've only worked 3, you need to buy 7. If you work 5, you have to buy a further 5. And that will give you a guaranteed income when you reach state pension age in the UK, which is 67 years of age.
For anyone who's received a lump sum payment and looking to invest it, where is the best place for them to put that money?
This is a question that I'm often asked, and I say to all individuals is be very mindful of just looking to invest money. And the reason I say that is that you need to understand what your short, medium and long-term goals are and how that money may be used to help you achieve those objectives, rather than just putting the money into some investment that you hope and believe will make you a return of monies. And sometimes it's a balanced approach between those 3 different pots. So the key point I'd make is that as much as it's hopefully a good position to be in for that individual, get qualified advice, because it might make sense for you to put that extra bit of money partly towards your pension scheme to help boost your retirement income. It may be that it can help you pay down debt, and also then putting some of that money aside to avoid loans in the future or help you fund your children's education. So without giving a financial advisor the information to help you pick the right choice, sometimes can lead to making the wrong decisions.
Insurances like income protection and serious illness, would you recommend these for people?
So there are various financial products that individuals can purchase. These include life cover, serious illness cover, which is a lump sum if you are contracted with a certain illness or condition, and income protection, which pays a certain amount per month if you're out of work through accident, illness, or injury. It is important to know what options are out there for you. And I think it's important to understand, particularly if you're working for a company, what benefits they may provide. So the key message is, again, as part of a financial review, is check in and see from not just your perspective, but also for the household, what level of benefits that, individuals have, and then the costs of taking provisions to mitigate against these. Personally, I'd be more in favor of income protection, for example, than serious illness, because not only is it tax deductible, so you get tax relief on it, but that it also is a much lower qualification of you being able to claim.
Tell me about your upcoming webinar on FIRE.
So FIRE is a movement which stands for Financial Independence, Retire Early. And it's something that we've seen gain a lot more traction, particularly online. And FIRE originated back in the 90s from the US. What it essentially provides for is people who want to work hard and save aggressively in their early years, making quite big financial sacrifices to be able to be in a position where they don't have to work from as early as 40 years onwards. Whilst this may sound like a bit of a pipe dream, particularly if you've already reached the age of 40, there is a lot of, sense in it on the basis that there are variations. For example, as a 50-year-old myself, I feel that, the whole premise of FIRE works favorably in that it puts good habits into people to ensure that you're not spending money in the wrong areas, that you're making your money work as hard as possible, that you're reducing the amount of tax you pay, and you're focused on reducing down the debt you have. And so for that purpose, I think that FIRE works for all of us on the basis of not having to rely on the state to provide us that income in retirement.
Millionaire habits. Do you have any?
So it sounds like a bit of a cliche, but certainly, personally, I look at what has made people successful and how people use their money effectively. And certainly for me, there are definitely some takeaways that we can all get from picking up the habits of others, whether they be millionaires or indeed billionaires. Reducing tax, for example. There are many legitimate ways to avoid the tax man. And it's important that you know, whether you're a business owner or a POE or self-employed individual, how best to do that. It's not just through pensions. There are other vehicles available, such as the Employment Investment Incentive Scheme, and also other ways in which we can mitigate against the tax we pay. The other takeaways really are focusing on the financial budgeter. Where are we spending our money? How can we ensure that we're not spending it in the wrong areas? Don't overpay for insurances. For example, many business owners don't necessarily realize, but they can get their business to pay for a lot of the insurance costs they may still be paying for themselves. And one of the major ones is every euro you have in the bank, wherever it might be, make sure it's working as hard as you do. And that's getting a return of interest that at least beats inflation.
And your top tip finance book?
A book I read many years ago and I stand over is called Rich Dad, Poor Dad by Robert Kiyosaki. It is a book about a boy who has notionally two fathers. There's a father that basically doesn't have a lot of resources, and there's one that's done really well. It's a fantastic book. I would encourage everybody to read it. It's the biggest financial book that has helped me in my career and personally.
And I'm going to finish on this one today. For anyone that is struggling financially and just needs a little bit of help, what would you recommend?
The major thing is being able to talk to someone. I think like any problem that we have, if you can share it with somebody, it does make it certainly a lot more palatable. in Alpha Wealth, we come across a lot of individuals that, have suffered from the cost of rise increases that we've experienced. They may be struggling with loans. And again, as an individual myself with 4 children and a blended family, I can see how costs can rake up. The main thing is to really have an understanding of where you are and how to start to manage towards fixing the problem. And I find for a lot of individuals, time can be a healer. We just need to focus on the solution. And that's something that I do suggest that they would reach out to a financial advisor. And particularly, we'd like to be able to put ourselves in a position where we can help people without putting them into any, major further costs.
Thank you.